Thank you everyone for joining us today for this business hour, creative project incentives, creative project financing, incentives for a recovering market. I'm Andy Gardner, a member in our real estate practice. With me on the panel today are, to my right, your left, is Ted Esborn, the chair of our environmental law practice. Next to Ted is Chad Arfons, a member in our real estate practice group. Next to Chad is Mike Wise, co-chair of our energy practice group. And at the other end of the table is Jeff Huntsberger, the chair of our real estate practice group. We'll be happy to answer questions from the audience during the program. You've been provided with cards that conveniently say question in big letters at the top. Feel free to mark those up, and if you hold it up, one of the staff members from McDonald Hopkins will come by and deliver it to us. For those of you participating outside Cleveland on the webcast, you can email us questions by clicking on the screen, and they will deliver it to us as well. So today our topic again is creative project financing, incentives for a recovering market. And what we're hoping to do today is spend just a few minutes with a number of topics, helping give you some ideas to close the gap on equity necessary to complete a project. As we were talking internally about what might be helpful for people is, even as the economy's recovered, real estate has still got a little bit of a specter associated with it. Nobody's really sure what it might be worth. Consequently, it's still harder and harder to get banks to loan significant amounts to new real estate projects. So what we're hoping to do is give you some ideas for ways to close the gap. In your materials, you have a case study that we're going to be working from here. And essentially what this is just to give a little bit of a frame of reference so that we're not speaking quite in a vacuum. Sometimes we thought when you start talking about particularly government programs, if you don't have an example to refer to and something solid for people to grab onto, it's a little bit harder to understand how the program can be meaningful. So in our case study, and I'm just going to hit a couple of the highlights, what we have is a manufacturing company, so it's an owner, not a developer, that wants to put a new plant on approximately 20 acres in the metropolitan area of Ohio City. It's a designated enterprise zone for that city. The facility would include a new 50,000 square foot research and development building, a 20,000 square foot office building, and would rehabilitate about a 110,000 square foot manufacturing plant and warehouse. The site's composed of 3 different parcels. Parcel A is 4 acres. It's the former location of a foundry. It has been mothballed for many, many years, closing in the mid-70s. Other than some vacant buildings and several recognized environmental conditions, there was nothing left on it. Eventually, the city took it into their land bank program, demolished the buildings, and it's now vacant except for trash, weeds, and some unknown contaminants. Parcel B is 14 acres. It's the location of a former automotive producer's facility. The Arfons Automotive Company started operations in the 1940s, shuttered its businesses in the 80s after 40 years of production. After that, a developer took control of the warehouse, subdivided it and leased it out, and continued to do that until a few years ago. Again, this is a 110,000 square foot building. It remains in usable condition, but it has some deferred maintenance issues and is quite expensive to heat. The last parcel is a former warehouse. It had a 35,000 square foot, or has a 35,000 square foot building on it that was in use until about 5 or 6 years ago, but is no longer in usable condition. Our developer has come in, or our owner, and if I hit this right, they've put together a budget that they think it'll be about $21 million to get this project done. They've arranged for debt financing for about $13 million of it. That's roughly a 65% loan-to-value ratio. When you look at what would be eligible, some of the costs that they're going to be incurring are public improvements that we don't believe the bank would lend against. But if you take a look here, the uses, about $3.5 million for the purchase of the land and the building. Another roughly $12 million of construction and renovation, some public improvements to the tune of $1.65 million. The environmental assessment and remediation, although they aren't positive, we've come up with a figure of $450,000. They're going to pay taxes on the building materials of about $400,000, $1 million of soft costs, and then a couple $1 million of FF&E. I assume you'll all forgive us in taking some liberties with putting these numbers together. We've tried to make it so it looks pretty good when we let you know what some of the programs are that we think would be helpful to the owner here are. So I guess the best place to start is, as we've mentioned, this is in an area that has been identified as an enterprise zone and is developing. And we're going to ask Chad to talk about one of the primary incentives that people have heard about, which is the New Markets Tax Credit.
Sure. The New Markets program is one that gets a lot of attention from developers and people doing projects. It's a program, the federal program started in 2000, and the state of Ohio created a companion tax credit program in 2009. And it's essentially, in the case of the federal program, a 39% credit on federal taxes, and the state program is a 39% credit on state taxes. And the purpose of both of the programs is to really incentivize investment in low-income communities. It's a fairly complicated tax credit program to navigate, but at the end result, there's meaningful benefit brought to the project and to the investors that are willing to make an investment in it. Because it's complicated, it's essentially it's a tax credit that I would advise clients that you really need to be looking at a project of maybe $5 million or greater, because just the difficulty in kind of navigating it. The way that it's typically structured is an investor, which would be usually an insurance company or a major bank or a publicly traded company, will make an investment in a community development entity which has received an allocation of these New Markets credits from either the Treasury Department or the state of Ohio, and then that community development entity takes that investment and makes an investment in a qualified low-income active business. It's called a Qualic-B. This program, you'll find, has a number of acronyms and makes it just especially complicated. But essentially what happens is through a series of loans and equity investments, the investor benefits from a tax credit that is taken over 7 years, and the developer of the project or the owner of the project benefits from what I'll call soft loans or equity investment that might otherwise not be available to such a project. In this case, we've looked at it and determined that this is a low-income community based upon the census tract, which is how these New Markets qualify, and the nature of the investment being creating jobs through manufacturing company is one that seems attractive for the New Markets program.
Chad, what are some of the other uses in addition to manufacturing that New Markets is available for?
Sure. It can be used for really any number of programs. Its designed or its intent is to create jobs or kind of incentivize community outreach in these low-income areas. So projects that kind of focus on that are kind of the most desirable. It's a competitive program, so your project has to essentially make a compelling case for why it should get these credits, and so I would say things like building hospitals or educational facilities or projects that will create jobs in low-income communities are probably the most desirable.
Are there any things that are just ineligible?
There are ineligible programs. Unfortunately, you can't use the credits for massage parlors, suntan facilities, golf courses, and a few other kind of bad boy projects. So if those are on your list, you can take those off. Those won't work. But But otherwise, not-for-profits can use new markets, for-profits can use them. But essentially, it's a program that the end user, this qualified, active, low-income business, needs to show that it's using the funds to create jobs, and has to really make a commitment to reach out to the surrounding low-income community. In this case, we've looked at it, and essentially the components to the New Markets program, it can be used to leverage, I guess I would say, or incentivize any of your project costs, by and large. So your acquisition costs, your hard costs, your soft costs, the rehabilitation costs, I'm just kind of looking there. Those can all be leveraged, and it's really a function of what size allocation of New Markets credits you get from the community development entity. So in this case, we have a $21 million project. You wouldn't get an allocation of greater than $21 million in this case, and you probably would get something less than that, but again, it's kind of a competitive process. But what we've determined for purposes of this analysis is to say a net benefit after all of the fees and costs would be approximately $2.5 million to this project.
So if we take that there and apply it to our case study, we've taken a situation where initially the owner needed to come up with $8 million of equity, and we've managed to pull $2.5 million out of that, and it reduces the owner's equity contribution down to $5.5 million. I guess, Chad, the one thing maybe to go into a little bit more detail is how does this actually get liquidated at the beginning? The tax credits are allocated to the Qualic B, right, if I'm saying that right. And so how do they actually take that out to the investors? Sure. and liquidate that to come into the project? Sure.
The program has kind of an active market of these community development entities that have received the allocation and essentially receive a new allocation every year. The program was recently essentially extended for 2 more years, so it's going to be in effect for 2013 and 2014. Or I guess it's 2012 and 2013 it was extended for. But at any rate, there is also kind of an active market of investors that participate in these programs. And essentially, you shop your project to community development entities to garner the interest and receive an award. And then you go out and you try to find an investor that would be interested in investing in the project. Typically, the benefits of the program are received, essentially the equity or soft loans, if you will, are received at closing. So the developer or the owner has the benefit of those funds on day one. Great. The program then stays in effect. There's a compliance period for 7 years, and then it's structured such that if the investor chooses, they can exit the investment after 7 years.
Okay. The next program we want to take a look at is how local port authorities can come into the project and again help reduce the equity input from the owner. And I think most of us here in Cleveland are familiar with the Cleveland-Cuyahoga County Port Authority, but many people are surprised when they hear that states deep in the central part of, or counties deep in the central part of the state without access to Lake Erie or large rivers also have port authorities. And so, right. Jeff, can you describe a little bit about what a port authority really does and its role and what it could help our case with here?
Sure. I mean, Cleveland is the classic port authority, right? If it weren't snowing so heavily out there and we lift up the blinds, you could look out, you could see the Cleveland Port Authority. When it's in the news, it has to do typically maybe with a little bit of corruption scandal here or there, not, but setting that aside for a moment, it has a lot to do with shipping, with boats, right? And so we tend to think about port authorities as shipping, but you know, so what's going on in Columbus and Dayton, Montgomery County and Summit County port authorities? Well, there are actually 52 of them spread around the state. And I guess the moral is you don't need to have a port to be a port authority. Okay, so if you don't have a port, and if you don't even have the rail lines that port authorities are often involved in, the airports, as down in Columbus, the port authorities are involved in, what's their purpose? Well, you know, they're really great development tools for local municipalities, and in turn businesses. And they have a wide range of powers under the Ohio Revised Code, things that have nothing to do with shipping or longshoremen. And they can, among other things, enhance, foster, and provide or promote transportation, economic development, that's the key word right there, housing, recreation, education, government operations, culture, or research. Specifically, those powers include the ability to own real estate, acquire real estate, own, sell, construct, and lease improvements on that real estate. That's important. We're going to come back to that. They can issue revenue bonds for the Port Authority facilities where the obligation to pay is directly from the revenues, okay? There's no personal obligation to the Port Authority in that case. It's coming directly from the revenues. But they can also issue general obligation bonds which obligate all the resources of the Port Authority to repay in the bonds, provided that the voters in that jurisdiction have approved. They can also receive federal and state grants, loans, other public funds. They are essentially a political subdivision. And who are they formed by? They're formed by the local governments. Here in Cleveland, we have Cleveland, County of Cuyahoga. In Dayton, you have the city of Dayton, Montgomery County. You can actually take any group of townships, counties, municipalities, and together they can form a port authority.
So how would they help us in this deal?
Well, one nice thing about governmental entities, subdivisions, is that they don't pay sales tax on what they acquire. Okay, so when the county acquires something, when the township acquires something, builds a building, for example, they don't pay sales tax on the materials. So what if we, in our situation, ground leased the facility that we're talking about here to our local Port Authority and said, hey, Port Authority, why don't you go ahead and put up the improvements on the property and lease it back to us. In fact, that's something that's done very commonly by port authorities. It's a capital lease. It's not a true lease, but it's really it's a great tool for economic development. And in our situation here, we're talking about $13 million of building improvements between labor and materials. So you figure generally about half that, about $6.5 million is materials that's going into the project. You multiply that by 6.5%, and lo and behold, you get the $400,000 that we're talking about up here. It's $400,000 of sales tax that the project would pay if it were owned by our company. It's $0 of sales tax that the Port Authority would own. Okay, so how do we go about this? How does this work? You find an investor who's interested in buying Port Authority bonds. This investor purchases the bonds from the Port Authority. The Port Authority now has this improvement to construct, right? What does it know about constructing improvements? It doesn't, really, for the most part. So it hires our company to be the construction manager to put up the improvements. Now our company, as construction manager for the Port Authority, needs to pay the contractor, like you would in any construction situation. How do we pay the contractor? Well, the money goes from the bonds down to a trustee for the bondholders. And when work is being done on the project, our construction manager company, on behalf of the port, says, hey guys, send us up some money. Money comes out of the bonds, out of the trustee, and goes to the contractor. That happens until the project is complete. As those draws come through the loop there, who's going to pay then? Who's going to pay the investor, right? The Port Authority in these deals actually has no general obligation to pay on the debt. So how does it get paid? It gets paid through rents that our company pays to the Port Authority, which is now the owner of the facilities. It's a nice round robin kind of situation. It involves a lot of documentation. It involves a lot of attorneys and Port Authority fees. In our case, we're saving $400,000, but frankly, you're probably talking about, my over already, Andy?
No.
Yeah, okay.
I don't even know where that came from.
Oh, no.
If you need to talk faster, Jeff, we'll hit that button. And you, okay, all right. That was for Chad, I'm sure. So we have about 125,000 pretty typically in these deals. So the net benefit in this case is only really about $275,000. Recently, we did do a much larger transaction where the total cost was about $70 million. We saved the client, in that case, $3 million. Client coming in from out of state to put in a large manufacturing facility down working with the Dayton Montgomery Port Authority. So you can see the bigger the project, the more money you're going to save. Does it equal what we see with the new markets stuff? No, it doesn't. But we've been able to figure out a way here at the firm that, in general, we can probably meld these two things together. You think, new markets is complicated. You think the Port Authority is maybe a little less complicated. You put the two together, and it's like brain damage. But it works. And if you can do that for a client, if you can do that for a customer, to show them how to take advantage of the new markets, how to take advantage of a pretty substantial sales tax savings, it works. And then you may say, Jeff, okay, this is all fine, but now we have a lease that our client doesn't own anymore, and so, okay, well, the way it works is that when the bonds are over with, when the lease is over with, whatever remains outstanding on the bonds gets paid by our company here. And at that point in time, the two leases involved, the ground lease that our client leased the ground to the Port Authority, plus the Port Authority lease terminates. Lo and behold, we end up with the property free of any leases with these improvements on them, free and clear. We buy them for $1. Now the accountants in the audience will say, of course, that's not a true lease, right? That's a capital lease. It's a financing vehicle, which is true. So this does not, in this instance, take any of this stuff off the books of our company. At the same time, though, it permits us to take the deductions during the course of the lease. Because as far as the federal government is concerned, our company owns the property, not the Port Authority. Interestingly, under Ohio law, the Port Authority owns it. It's a lease like any other lease under Ohio law. So neat opportunities, and you meld these two things together, it's pretty cool. The last twist in all this is the last two deals that we've done, the company has actually bought their own bonds. Yeah, I know. Okay, so take it all the way through that whole loop again, and now the buyer of the bonds is our company. The obligor on the bonds is our company, and it pays itself essentially rent to pay on the bonds, and it all circles through. And of course, why in the world would you do it? It's to save a lot of sales tax. Why would someone offer this to you? The Port Authorities aren't just simply offering this to anybody who comes into town. You need to, as in the case of the new markets, you need to be providing some jobs. It needs to be a project where the mayor can stand up and put his arm around you and say, here's what we're doing in our town. It needs to be something which is going to get some publicity. But it's a great opportunity. The jobs don't have to be huge. In this most recent deal that we're doing, it's just 30 jobs. So we're not talking like 200 or 300 jobs. Andy, I think that's,
No?
yeah.
Thank you, Jeff.
If you have some more questions.
So we've seen a federal and state tax incentive. We've seen what a Port Authority can do to come in. Mike, if you could touch on maybe what some of the other state and local incentives are, and in particular maybe focusing on some of the public improvements that we're going to make and the fact that we're in an enterprise zone.
Sure. And you can just let me know if I run over.
Believe me, you'll feel the buzzer.
It's in your seat, actually.
Just dovetailing off of Jeff, it's interesting, there's 52 port authorities, and that number is actually growing, even though they can cross jurisdictional lines and the Cleveland Port Authority can do deals in other parts of the state. It actually generates revenue for the Port Authority, the financing from these deals, and so they pay staff and they also help fund some of their programs. We were down in Steubenville this week, and it's a growing area because of shale gas. And Jefferson County is going to set up their own port authority. So it's a small county, very small population, but they're going to set up their own port authority and do financing for projects. Generally, as far as incentives, I would encourage all of you, if you don't get cranes, there's an article on the front page of this week. It talks about Jobs Ohio altering its vision. And Jobs Ohio is the new private entity that's now doing economic development in the state of Ohio. And it's just interesting to see the evolution of economic incentives in the state. Under Governor Voinovich, it was very much focused on manufacturing and job creation. Under Governor Taft, you saw a move towards technology and job retention. And this governor, and you'll see in the article, he wants to talk about rates of return. I mean, he came from Wall Street. He likes that lingo. So when he talks about an incentive package for a company, he wants to see the local tax revenue to be generated, state tax revenue to be generated, compute a rate of return, and he be able to justify then the state incentive that's being offered based on those returns. But the quotes are just classic Governor Kasich, because when he came in, he was so upset about these companies that were leaving and the packages being offered by other states. And now he's saying, well, if a CEO calls me up and says he wants to go, I'm going to show him where the door is, because that's not what we're about here in the state of Ohio. We're going to build our infrastructure, and either they're going to love it and want to be here, or they can go. Well, I think that made for a good quote in the paper. That's certainly still not our experience. I mean, they want to compete. And it was interesting. I got to just tell one story. We were working on a project in a very influential congressman's district, and the initial proposal from the state perhaps wasn't as aggressive as everyone thought it should be. So the company called the influential congressman, and the influential congressman called the governor, and they got back within a couple weeks a new proposal that was much more to their liking. And that doesn't seem to jive with the quote that I see in the paper, but that's still how it seems like business is being done in the state of Ohio. We and the developers that we've represented, they'll look at something like those public improvements, and I would add the environmental remediation, and they'll tell us, listen, we're not paying for any of it. I mean, you need to go out and put together a local and a state package that covers all of it, because it's not coming out of our bottom line. So that was always, the starting point for the work that we would do would be to get rid of everything, ideally with grants. If not grants, at least do it with low interest loans. And between the programs that are offered at the local level and the state level, and in some cases even the federal level, that's still a possibility depending on the location of the project, the type of project, the job creation being done, or the job retention being done. But I think if you're doing a project, that should always be your starting point. And I know Andy wants me to talk a little bit about enterprise zones and TIFs. And here's what I would say about this. And we're doing a project right now in Cleveland that involves tax increment financing, and we're doing one down in Dayton that involves an enterprise zone. And typically, the developers that we've worked with, they gravitate towards the enterprise zone first, because they're going to get relief from taxes, and then they can go and look at other programs to try to get relief from some of those public improvement costs. So it's not an all or nothing. It's I want it, and I also want the other programs that are available, because I want to erase my public improvements, but I don't want to do it at the expense of tax savings. And tax increment financing is erasing your public improvements at the expense of tax savings, because what you're doing is you're saying, I'll pay my taxes, but typically 75% of those taxes are going to go for debt service on a bond, and those bond proceeds are going to be available for those public improvements. So it's, I don't want to say that you would never go to a TIF first. Sometimes all you can do is a TIF because an enterprise zone isn't available. But typically the aggressive developer is going to say, if they're in an enterprise zone, I'm taking the benefits of the enterprise zone, but you're not off the hook. Go get me some other money to cover the public improvements. The full $2 million that's on the example.
So I guess maybe just to help people out a little bit, if we take our scenario here where we've got $1.65 million of public improvements, being conservative, and we wanted to go out and try to say, hey, what's realistic? Is it maybe something like $1 million of tax increment financing that we're showing that's realistic for the developer to get, and you know,
Gosh, it is.
how does that TIF work?
Right.
When he goes out to say, you know, okay, I want to do this.
So Andy really wanted to make his case study look pretty, so he's going to focus on tax increment financing because it does. It can be a source through the bond of capital to take down the public improvement number. If you were to just take advantage of the enterprise zone, I mean, that's not bonded. Those tax savings aren't bonded, so that's not a lump sum that is then available for your public improvements. I think $1 million, we're doing a project right now up here that's a $10 million project, and we're going to realize about $1 million net for public improvement. So for this project, I think $1 million TIF it's a good number. It's a very conservative number.
Okay, so taking a quick look back to our case study, and again allowing us the liberty to try to make it look good. In this case, by taking advantage of the tax increment financing, we've again managed to lower the equity contribution of the owner from what it started. I'll remind you, back at $8 million. Now we're down to $4,225,000. So I guess at this point, I'll remind you, you can fill out the cards to ask questions. We've got one in, and we're going to get through one more program, and then we'll take a quick break and answer any questions if you want to send them in. So one of the things we mentioned in the case study is that a good chunk of the property here, about 20% of it, is contaminated. And for that, there is a State of Ohio grant program that you can take advantage of, and Ted's going to tell us about that.
That's right, Andy. That fund is the Clean Ohio Fund, which has been the linchpin of Ohio environmental grants for over 10 years now. The fund was actually created in 2002 after Ohio voters approved the sale of $400 billion in bonds back in 2000. $200 million of those bond proceeds were dedicated to a brownfields assessment and revitalization program. And over the first phase of this program, when those $200,000 were expended, $200 million, excuse me, over 65 properties received remediation grants, and over 174 properties received assessment grants.
Maybe describe the difference real quickly between the assessment process and the remediation process.
Assessment is where the property is actually assessed. We do an assessment, and actually it's a certified professional under Ohio's VAP program who does an assessment of the property to determine if there are any regulated substances that have been released onto the property. Under the original Clean Ohio Fund, up to $300,000 was available for that kind of work. The revitalization aspect of the program then involved the actual cleanup or risk assessment of any environmental conditions identified in the assessment process. So, first phase, the first expenditure of $200 million went so well in this program that the Ohio voters in 2008 said, let's do it again. Authorized the sale of another $400 million in bonds, $200 million of which were set aside again for brownfield assessment and revitalization. That program again went forward, pretty much the same brisk pace as the first stage did, until we came up to June 30th of last year, where the Kasich administration said, you know, we're winding down, these funds are about done. And there was a lot of conjecture as of the June 30th termination date for the program, whether a grant program would continue. Of course, the governor's very focused on Jobs Ohio, and is much more inclined to take the state liquor tax proceeds and devote them to those purposes rather than environmental programs and remediation programs. So a lot of people thought, geez, is this the end of the grant program? Well, Governor Kasich said it certainly is not the end. We are going to continue a Clean Ohio Fund, and he did so. What they've done is allocate another $15 million for another round of Clean Ohio funding over 6 months. I call it Clean Ohio Light, but thank God it's still here and will still be heavily used. $3 million of that $15 million will go to the assessment aspect of the program, or what's called the Clean Ohio Assessment Fund. And that money will be available for assessment grants up to $200,000. Remember, before it was $3, we see a reduction there. The remaining $12 million allocated will be for the Clean Ohio Revitalization Fund, and that is for the actual property remediation. Maximum amount of grant there now is $1 million as opposed to $3 million under the former program. The assessment fund is now administered by the Ohio Development Services Agency, and they are currently taking applications for assessment grants. The revitalization fund is being administered by the Clean Ohio Council, but they are not, as of yet, taking applications. And the reason they are not is they are still adopting the policies that will cover this new version of Clean Ohio. They have a public meeting next Wednesday, the 6th. They published proposed policies last September. They hope to finalize them next week. We're anticipating that they will. Once they will, the program will be off and running again. All remediation done under this program has to be done under the Ohio VAP, Voluntary Systems Program. You have to have a state qualified, certified professional overseeing the work. Applicants have to have what are called clean hands to qualify for this. That is, the contamination that's to be cleaned up cannot be put there by an applicant. You have to have at least one public entity as an applicant for these funds. It can be a municipality, a township, a county, a conservancy, or a port authority. That public entity can partner with a private entity. It can be profit, it can be nonprofit. Under our scenario here, our situation would certainly qualify for a Clean Ohio grant. We have a public entity owning the property in a municipal land bank. We have a private developer. They would partner. They would apply. There are some new twists under the proposed policies. What an applicant will have to do now is, before they even submit their application, they first have to meet with the state at the site, with the Ohio EPA and with the Ohio Development Services Agency. This is kind of like a vetting process where they determine that the proposed work is both VAP eligible and Clean Ohio eligible. If they pass that phase, they then have to fill out an application, post it at a local library, post a sign at the site indicating that these applicants want to apply for Clean Ohio funds. They then have to allow a 45-day public comment period for any written public comments, and they, the applicants, have to hold a public meeting at the library to receive any oral comments, public comments. They have to compile a list of those parties showing up at the library. They have to provide a transcript and a summary of any public comments that were raised. And then that written summary becomes part of the formal application, which is then submitted to the state. The state then reviews their application, provides any comments. The applicants are allowed to respond to it, and then it is ultimately submitted to the Clean Ohio Fund, who gives it an up or down as to whether the funds will be granted.
Okay, what does the owner have to contribute? Can you get a grant for up to 100%?
There is there is a 25% match required on the part of the applicants. That can be a cash match, it can be an in-kind match of services. You noted, Andy, that there were some demolitions at the site for the old foundry building. If that was done 2 years prior to the work commencing, they might be able to get a cash match for the cost of those demolition costs. Otherwise, or an in-kind match. Otherwise, we'll take a cash match.
Okay. So again, looking back here, we're assuming that after the costs and the contribution of the owner here, we could safely assume that we could get a grant with a value of about $337,500 to apply here. Again, further reducing the owner's equity contribution. Now we're down below the $4 million level. We're going to take a quick intermission here and answer a couple of questions. I guess the first is for Chad, and Chad, if you could just read the question.
Sure. This question is, do tax credit projects always require prevailing wage, especially in the city of Cleveland, where there are certain criteria in terms of minority participation and that sort of thing? The answer to that is no. There are no requirements under any of the tax credits, to my knowledge, with respect to prevailing wage or participation by targeted groups. I would say with respect to the new markets credit, that may be part of your overall, I guess, dressing up of your project to make it more appealing to receive an award of new markets credits, but it's not something that is required under the code sections.
Okay, I think our second question probably is best answered by Mike, so.
Okay, this question is with the gridlock in Washington. What, gridlock? Are there any programs or incentives that are in danger of being eliminated? Is there anything the audience needs to do? I mean, it seems like every year for the past 4 or 5 years, we've had extender packages that have come out of Washington at the end of the year where they extend various tax incentive programs that are important to this development and other projects that we work on, particularly in the energy sector. And the same thing holds true now, and we're going to fight this battle at the end of the year. But the production tax credit, which the wind industry really relies on, I mean, that does look like it's going to go away at the end of the year. The investment tax credit, which Chad's going to talk about in a minute, is a very valuable tool for renewable energy projects. And then, of course, the new market tax credit, that just got extended too, but it will need to be extended again. And I'll plug that new markets tax credit. We really didn't have that capability here until Chad came over, and it is, as you can see on the hypothetical, it is an incredibly valuable tool, but which unfortunately needs incredible counsel and expertise to access. And if you're doing a project and one in an eligible census area, get a professional involved that can walk you through it. We put together a spreadsheet for a client recently, put all the incentives out there, and there was maybe a dozen incentives, and then we ranked them by value, and the new market tax credits was at the top of the list and at the top of the list by far. And the client looked at them and said, why are we focusing on any of these other programs? Mm-hmm. Well, because they're more easily accessed than new markets are, but you gotta pay attention to that new markets.
And we had a third question, and this had to do with the Port Authority ownership structure, and I'll let Jeff read that one and answer.
So you gave me the income tax question, which, thanks.
We're providing no real tax advice here today.
Absolutely. Double underline that. I'm not sure I fully understand the question, but it says, how do you avoid the designation of installment sale and lease with salvage value? Will the IRS claim a tax or waived anyways because of sale by the county? I'm not sure that I fully understand the question, but I think the key in these things is that these are capital leases, so they're deemed to be finance vehicles. So from the IRS's standpoint, that asset which is being built by the Port Authority is really our company's asset. That's why it depreciates it, over its useful life. And again, from an Ohio standpoint, Ohio real estate standpoint, Ohio law, it is in fact a lease. But as far as the IRS is concerned, it's no different than, if one of the bankers in the audience were lending money to the company and the company was putting up the asset itself. The key is that at the end of the lease, the right is to buy the asset at $1 or $10, a nominal amount. If, on the other hand, you were buying that asset at the end for its true market value, well, then there's a much better argument that it's a true lease. But this in a lot of ways is not much different than the leases that banks will prepare for customers in connection with personal property assets of some sort. So it's really not a whole lot different.
Thanks, Jeff. Okay, one of the things that we mentioned was that a significant portion of the attraction to the site for our manufacturer was the existing building. It's old but useful. And that gives us a chance to look at the historic tax credit program, and we're going to turn it back over to Chad.
Mike plugged the New Markets program, and I would say that I will put in a plug for the historic tax credit program, and after that, the investment tax credit program for renewable energy. I described to clients the New Markets program as kind of a giant funnel where a lot of money comes in at the top and a little bit of money comes out at the bottom that is these soft loans or equity investment, and that's good. The historic program, really the money for the project comes in at the top, and the owner or the developer benefits from the vast majority of it. It's both the historic program and the investment tax credit are very efficient. They don't require a lot of brain damage, and so I'm a big fan of those. In this case, we have a building that's more than 50 years old, and for our purposes, we're going to say that it's a historic building, which means that it's on the National Register of Historic Places, or it contributes to a historic district, and thus it would qualify for the historic tax credit. There's essentially, just to take a step back, there's the federal historic tax credit program, which has been around since, I guess, the 70s, the late 70s, and then there's a state of Ohio program that it's a little bit different, but kind of operates on the same principles, that was started in 2007. The federal program is a 20% federal credit on the qualified rehabilitation expenditures, which are essentially the project costs that are essentially attributable to the historic renovation. Let's say that can be soft costs or hard costs. It wouldn't cover acquisition costs. The state program is a 25% state credit. The state program is something where it has to be competitively awarded. The federal is, if you follow the program, it's available. Essentially the steps in the process are that the building has to qualify for the credits by being historic, and then the plans for the redevelopment have to be reviewed by the National Park Service and the state of Ohio in the case of the Ohio program, and essentially the rehabilitation design needs to conform with the standards for rehabilitation, which essentially encourage maintaining the historic character and fabric of the building. And I guess just to sum it up, the bottom line is you bring in an investor for a historic tax credit project, and just like the New Markets project, it's typically going to be a bank or a publicly traded company, insurance company, that sort of thing, and they make an equity investment in the partnership that owns the project, and they receive the economic benefits from the tax credits. There's current case law out there now. It's kind of developing case law called the Historic Boardwalk case that really emphasizes the fact that this has to be a true partnership type investment where the investor comes in and shares in the risks and the possible benefits, but they can also receive the disproportionate amount of the tax benefits. And by structuring these transactions this way, it brings a significant amount of equity to the project for the owner to get it done.
And again, just like the New Markets credit, this is available way beyond the manufacturing world.
Absolutely. This can be done. In this case, the owner of the project has to be a for-profit, but we have clients that are not-for-profits that have benefited from this program, developers, manufacturing, hospitals, kind of you name it, any entity that's taking a historic building and rehabilitating it can benefit.
So institutions with lots of old buildings
Exactly.
that aren't planning on replacing them might be looking at this.
Exactly, exactly.
So going back to our quick fact pattern, you took a look at the numbers involved, and the magic answer was?
And I think this number is very conservative, frankly, but I didn't want to be too aggressive, but this would be the benefit of the state and the federal historic tax credit for this project.
So totaling just over $2.5 million. So just to remind everyone, we started at 8, and we've now whittled the owner's equity contribution down to 1.317 million, which is a nice way to go when you're garnering money from all kinds of outside sources to make your project a reality. I mean, obviously we've cobbled together quite a number of different programs, and the fact pattern somehow was just right to be able to do it all. But we appreciate you understanding us taking some liberties there. after you take advantage of all of these grants, there are still some additional ways to achieve some savings, either by taking a look at alternate ways to fund some of the debt financing, or at some operational ways to do it. And I'm going to ask Mike to talk for a couple of minutes about what you can do with some of the energy savings that are available out there now.
Great. Real briefly, at the start of your project, and we didn't talk about this yet, but LEED certification is something that you probably should consider. A lot of businesses that would be important in your supply chain, the folks that you do business with might want to see that you're LEED certified, and if you want your project to be LEED certified, you're going to need to get a professional involved early on and help you through the necessary changes to make sure that you can get that designation. One of the items that's important for LEED certification is how do you power your building? So you could get points, or you would get points if you use renewable energy as part of your project. So that's one reason to consider renewable energy. Another might just be that you can get power cheaper, believe it or not, through a renewable energy source. And another, Cliff and I were talking about this morning, is when you pay your electricity bill, you're paying the utility, and you're paying the utility as part of your electric bill for their capital expenditures. If you decide you want to, for instance, put solar on your building, you're actually going to pay yourself for your own capital expenditure. So solar, which has come down dramatically in pricing, can now, if it's packaged properly, compete in a lot of jurisdictions on price just in of itself compared to the price that you're going to pay with your utility. But then you have the additional benefit of that you're funding your own CapEx instead of funding the utilities CapEx. And the cornerstone still of a renewable energy project is the investment tax credit. And that was, for a few years, it was actually, the ITC was on steroids because you could get a grant in lieu of the credit. And that really, no pun, powered the industry, both the wind and the solar industry. Now it's reverted back to just a credit, but it's still, depending upon the tax appetite of the owner, they may be able to take advantage of the credit, but even if they can't, you can package that credit with other credits like the depreciation credit and sell them. And you're not going to get 100% of the value, but you're going to get a good percent of the value, and you're going to get enough percent to make the pro forma to make the return on investment attractive. So I guess my message is to make sure that energy evaluation is part of your project, and to maybe take a new, fresh look at solar. It never really could compete, but now because of the price of the projects and because of the incentives that are still available and because of creative structuring, you can make solar work, potentially work at your project site.
Chad, anything you want to add on the ITC?
Well, I guess first off, in light of the historic boardwalk, I would say we can't say sell the tax benefits. It's a partnership. So just like I described with the historic credit, you would create a partnership for the ownership of the solar project. But the investment tax credit is a 30% credit, and then there are depreciation benefits that exist that just make solar, in particular solar, but renewable energy, I think much more viable than probably it had been considered before, and I'm very excited about the possibilities for solar going forward.
And I promise not to do a tax credit deal without you.
Okay. As I mentioned, two other quick programs that are available, not necessarily to cut equity, but maybe to cut some of your financing costs, involve Port Authority financing, and then some financing for brownfields that lets you do a little bit larger project than we had in our case study. So I'll ask Jeff to just, for maybe about 2-3 minutes,
Sure.
touch on what the Port Authority can do to finance.
We'll go fast. So we talked about capital leases. That's certainly not the only thing that Port Authorities do. And one of the most important programs really is their fixed rate bond fund. It varies by name depending upon the Port Authority. But essentially what it's doing is permitting smaller businesses to access the capital markets. And how do they do that? There's actually a series of reserves that are placed in with the Port Authority supporting these bonds. So if you're a company that's looking for financing, really usually typically between the $1.5 and $6 million range, usually settling somewhere around $3 million as an average, you can end up with some low-cost interest payments, low-cost financing. You know, in today's world, that's not quite as important as it was several years ago, but it's still important, and I guarantee you someday it's going to be more important again. These things are typically fixed rate for 20 to 25 years, require equity of about 10 to 20%. Between four of the big port authorities, Toledo, Cleveland, Columbus, and Dayton, they've done 85 of these transactions for a total loan of about $350 million. So these are true programs. They focus on owner-occupied premises, typically require personal guarantees, structured in a lot of ways like a typical loan might be, but just the potential to get a little better deal on the interest and, you know, a fixed rate for a long period of time. You can't typically do that at your local bank. Second thing I want to talk about just very briefly too is that they're actually excellent vehicles as conduits for getting directed loans and bond proceeds from specific state programs. And we had a client in Marietta who relied very, very heavily on service water. This isn't water which gets dirty as a part of the process. It's water principally serves the purpose of cooling down their manufacturing process. And they and three of their neighbors were dependent upon the water service being obtained by another neighbor who decided, sorry, we don't think we're going to do it anymore. And suddenly they were in the position potentially of their businesses being shut down. This would have put hundreds of employees out of work. So you can imagine in the Marietta area, they were very concerned about that happening. So the Port Authority, Southeastern Port Authority, stepped in and helped them. And there were it's $11 million project to, and just, you know, it's really kind of cool from an engineering standpoint too, how you draw billions and billions of gallons of water from the Ohio River, put it through these processes. I'm talking about over the course of just a few days, you know, and just the hundreds of billions over the course of a year. How you get it through these different companies, through all the piping up and around, and then back down into the river. Again, it's not water which really obtains any pollution through the process, but there still are discharge requirements, Army Corps of Engineers and aside. So at any rate, they were able to obtain $4.17 million of loans from through the Ohio Enterprise Bond Fund through the Director of Development of Ohio. And that is a credit-enhanced program, a little bit like some of the Port Authority stuff I was just talking about, but on steroids. They make larger loans. And then on top of that, we got a $6 million, that was actually a bond deal. Then there was a $6 million direct loan to the port by the Ohio Water Development Fund. That was something I'd never heard of before. But their responsibility is to help companies obtain water where necessary, among other things, and this was the perfect example. So it was really a fun deal. It was fun working with those four companies too to arrange their various ownership of the LLC that we put together. But that is actually up and running. They're using that water now. And it's the same kind of program where these loans are made to the port, bonds are issued to the port, and then the port actually has no general obligation to repay them. The obligation is pushed off through lease payments to our company and the other three companies. So another deal where the bonds are being paid, the loans are being paid through lease proceeds.
So again, depending on the situation here, the need for water, there are programs available. Our last example, in our case study, we had a relatively small remediation, but if you've got a larger remediation, you can get loans as low as 2% from the state. And I'm going to ask Ted just for 2 minutes to touch on the Brownfield Loan Program, and then we'll take any last-minute questions and wrap up.
Funding comes from the Ohio Water Development Authority, but the program is actually administered by the Ohio Development Services Agency. As Andy said, loans available up to $5 million for site revitalization, up to $500,000 for assessment, threshold's much higher than the Clean Ohio grant program. Other big difference is eligibility. I told you that under Clean Ohio for the grant, you had to have this clean hands, meet this clean hands requirement. That is, applicants could not have caused the contamination that needed to be cleaned up. Difference here, applicants here can have caused the contamination. They are eligible as long as they are not under a cleanup order to remediate it. So, big project, you got to get something done. As Andy said, loans with interest as low as 2%, 5 years to pay back assessment loans, 10 years to pay back revitalization loans.
All right. If anybody has any questions here in Cleveland, you can come up and visit us afterwards. If you want to email something in if you're online, please feel free. We promise to conclude by 1 o'clock, and that's what time it is. Thank you all for coming, and have a great afternoon.
Who did this?
Get that.